So in my Q4 2025 breakdown video, I had a mistake in how, well, not a mistake, but an assumption that was kind of buried in my model that I want to reveal to you that makes a pretty significant difference in what the possible outcome could be. And I think I was it's hard to say, possibly not, but I think I was a bit too bullish with that assumption. So the mistake was that my annual dollar retention was too high. I had it going into like the mid 94, 95% kind of range. And the annual dollar retention is a function of how your premium per customer for a cohort is changing. So as a group of customers that comes in the door in a quarter, so whoever comes in the door, say, in Q1 of last year, 12 months later, if you evaluated that same cohort of customers, whatever their premium per customer relative to what it was then, that ratio is your annual dollar retention. So we can estimate it based on the overall book of businesses changing premium per customer. I've had a few people ask me this. In my model, I have a 98 or a 2% kind of discount on that value. That's because going back to Investor Day 1, Shai told me that my churn values, which are also partly a function of your annual dollar retention, he said they were just slightly off, and I made that adjustment after that time. It's hard to say if that's still the case, but I've left it there in my model because that would just be essentially saying the premium per customer for the cohort is changing at a slightly different rate than the overall book of businesses premium per customer. But regardless, that's how I've been calculating that. And your annual dollar retention in my model for 2025 is a function of how the premium per customer is changing. But the premium per customer I have as now, the way I'm modeling it now, if we scroll down in my model, down past a couple black lines here, we have this whole section of the breakdown of policies of different product types and the number of customers. And if you look at the sort of summary section of that, I add up based on, each product line, how it's growing. This is based on the Q3 table that they gave us in the Q3 letter. They gave you all these details in each product and a bit of other estimating between renters and home. Based on all of that, you can get a policies, the total number of policies. Now, it doesn't tell you exactly in that table how many it just says each policy type, how many you could figure out how many policy type, how many renters, how many, pet owner, pet customers, but you don't know how many of these are combined for one single customer, which then affects your premium per customer. So I did measure that over the last, bit of data we had was a policies per customer. And you can see it's actually decreased slightly, which makes maybe sense as certain customers that maybe have home policies have been canceled out, but it's been fairly steady at about 1.1 range, right? And we have a bit of other data on where this policies per customer has been. If you look at, this was back in Q4 2023 earnings for Lemonade. I basically said, hey, at Investor Day, 3.7% of U.S. customers were multi-line. What's the current percentage? And at that time, he said, hey, it's gone from 3.7 up to 4.5%. And at any rate, Illinois has more than 9%. So Illinois, where they've had CAGR a bit longer, has more than 9% of customers are what you call multi-line. So it doesn't, if you say that 3.74%, 4% back here at this stage doesn't quite square, but this is an average policies per customer. What he's citing here is a multi-line customers, meaning that some customers might have 4 or 5 policies and just be one single multi-line customer. Other customers might have 2 policies and still be a multi-line customer. So if every customer that had more than one customer or more than one policy only had 2 policies, we'd have exactly 10% already. But you can see it's a it's a little more than twice that, or half that, a little less than half that if it was the 4.5% overall average at that time. So that might be kind of a rough rule of thumb, that maybe on average you can kind of double that percentage there to turn that into roughly, what Daniel's talking about here, being 9% of customers are multi-line. And so previously in my model, in the video I showed there, I had 7% annual growth across this, and it makes sense. This it has been stable because they really haven't been pushing selling car. If you look at cars portion of the business, like if we scroll down, we look at car, for example, they had going back about a year ago, they had about 80,000 customers, and then that actually came down as rates increased, and now they're going to probably start to really scale that up. As we see, I'm modeling here right now, they go from maybe 60, 70,000 customers to 120,000 car customers at the end of 2025 potentially. So that's going to start to scale up. Because that starts to scale up, a lot of those policies might be doubled up with other policies. Maybe they have two cars, they get them both insured through Lemonade. Maybe they have home insurance or pet insurance, renters, whatever it is. They're bundling those products together. So this policies per customer should really start to rise. And because I had it at 7% growth, over the next year, then that pushed up my annual dollar retention. And then overall, I'll show you in a moment here, but pushing up the annual dollar retention pushed up sort of the overall unit economics and pushed up where my IFP was going. But I've since dropped that down now to 5% year-over-year growth, where we're growing to, maybe 1.2 policies per customer by the end of 2025, and then another 6% growth for the next 2 years, and onwards 5% growth going onwards from that. And that gives you an annual dollar retention. The 6% for 2025 gives you annual dollar retention of, about, let's see here, about 92, 93%, which makes sense. Even without car really growing, they've been at the high 80s. And then you start pushing in car customers into those, cross-selling it into those existing customers, your annual dollar retention is going to rise. So not quite as high as I had it before. And then at the same, 1.65 ratio of conversion of growth spend to in-force premium, you're getting, you're still going to probably hit 1,270 some IFP, 30, low 30, mid 30s growth over the next year, even at that rate. So that's where I'm seeing things, or where things could go. It's a very tricky metric as well to think about as a long-term strategy, or think about what their plan or where it might go, is this sort of policies per customer. Even if I flip to this graph from Investor Day 1, you can see that, there's a couple possible futures they're projecting out here. And one of the futures, either of these futures, whatever one you look at, say $23 billion, say eventually in one future number 2, and they say, at 100% average premium per customer, that's what they're talking about, that's US average. So divide that by 7.2 million users, like they suggest here, you're getting about, their average premium per customer is about $3,200. Is what they're estimating. So $3,200, and at some far out rate, and then and even here in the another table, they say 50% at $6 billion, maybe 50% of the average premium per customer. So maybe about $1,600. So they're saying about $1,600 premium per customer at $6 billion. Even if I scroll out in my model, I'm at, when I get to IFP some of the parts here, when I get to 2031, maybe in the $6 billion range potentially, your premium per customer at that is still only in the 800s, versus they're suggesting maybe you'll get all the way to 1,600 by then. So what would that do? What would it take to get even close to that? Oh, you need a lot faster growth in this policies per customer, which would then drive your annual dollar retention up, which those numbers would then mean your unit economics would look even better over the next number of years. So that's kind of the way I'm thinking about it, but we don't really know. I don't know if they even really know. It would be a majorly a function of how many customers are multi-line and what kind of mix, how fast they're growing in Europe and what product categories they're growing. It's a question of, are you growing and have opportunities to grow into these younger markets, renters, pet markets that you're continuing to push and dominate into, which they will, versus maturing and advancing the existing customer bases that you have as those get older. So I think it's going to be a mix of both, and it's very hard to estimate, where exactly they'll come in. Either way, it's a positive, because in the one sense, if you're always investing more heavily into the younger customers, you're just going to have more payoff later. But if you're also getting the payoff, hey, you're getting the payoff. So either way, it's really fantastic. And you can see here, and also this is from Investor Days 1, some of their potential numbers here. They're saying, hey, multi-line customer rate by 2027, maybe 25% multi-line by 2027. And so the multi-line number should keep rising. I don't actually know how I compare that, but 2027, I'm at 1.35 policies per customer by the end. But that would be different than the multi-line. So maybe you cut that in half. Maybe I'm suggesting they're even, how I'm modeling it, they're at 17% of multi-line, if you assume that the average multi-line customer has 2 extra policies. Some guy has 6 policies and some people have only 2 policies total. So it sort of as an average, you're saying, based on the limited data we have. But you can see that's how they were modeling, thinking about it, at least at Investor Day 2, or 25 to 35%, or even 20% to 35%. So I think even the numbers I have here longer term would be, maybe they're still a little bit conservative, but it's hard to say. This is a metric, again, we're making assumptions on, and we don't have too much data to really project into the future for. But this quarter and the next couple quarters in 2025, I think we'll really start to see some interesting results as CAR is rolled out. And then I made this little quick table here under side math tab in my model, and just want to illustrate that it makes a pretty big difference. If you have a few inputs here of your growth spend for 2025, your growth spend quarterly as just an average quarterly amount, cross sell, I'm saying is 32%, and then the ratio outside of cross sell I have from 1.15 to 2, and annual dollar retention, say 93%, then you get, depending on what ratio you pick there, you're going to get IFP of 1,260 to 1,295. Now, but if this is 90%, then you're going to get IFP from 1,230 to 1,260, somewhere in that range. So, and if we were higher, like 95%, 95%, you're going to be at 1,287 to 1,370, something in that range. So, which is more like how I was closer to what I was modeling previously, but I don't know, something like maybe 92, 93% is probably more realistic. And then I still think, we should be hitting IFP that's, over somewhere between the 1,250 to 1,280 range. Something like that would be my guess. So I hope this was really helpful. I'm going to actually modify that main video, and release it as a separate video altogether with just some of these numbers updated for 2025 when I release it to the public here this week. Thanks so much for watching. Remember, it's in the bag.